Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Imagine waking up one morning to find that half your life savings has vanished overnight. Not because of a market crash, but because you put everything into a single stock and that one company collapsed. This isn't a rare horror story. It happens every year to investors who ignore one simple rule: never put all your eggs in one basket. That rule has a name in finance: diversification. It means spreading your money across different investments so no single failure can wipe you out. Think of it as insurance against the unknown, because nobody, not even professional fund managers, can predict exactly which company, sector, or country will struggle next. Here's why this matters. If you invest everything in one stock and that company crashes, your entire portfolio crashes with it. History is full of examples. Companies once considered unshakable have collapsed within months, taking investors' fortunes down with them. But investors who spread their money across many assets barely felt the shock, because their other holdings kept performing. So what does real diversification look like? It starts with asset classes. Stocks offer growth but carry higher risk. Bonds provide steady income and stability. Real estate can generate rental income and long-term appreciation. Cash gives you safety and flexibility. Each behaves differently under the same economic conditions, which is exactly the point. Diversification also means spreading across sectors. Technology, healthcare, energy, and consumer goods don't all rise and fall together. When rising interest rates hurt tech stocks, energy or healthcare companies might hold steady or even gain. By owning a mix, you smooth out the bumps instead of riding one steep roller coaster. Geography matters too. If your entire portfolio sits in one country's economy, you're exposed to that country's recessions, political shifts, and currency swings. Adding international investments spreads that risk across economies that don't always move in sync. Here's a trap many new investors fall into: fake diversification. Owning 10 different technology stocks might feel diversified because the number is high, but if they all crash together during a tech downturn, you weren't diversified at all. True diversification means owning assets that react differently to the same event. This is where index funds and ETFs become powerful tools. A single fund can hold hundreds of companies across many industries, instantly giving you broad diversification without researching and buying each stock individually. For most everyday investors, it's one of the simplest ways to build a resilient portfolio. Real estate investment trusts, or REITs, let you add property exposure without buying a physical building. Bonds add a cushion of stability during stock market downturns, since they often move opposite to equities. Diversification isn't something you set up once and forget. Markets shift, and your portfolio's balance shifts with them. That's why investors periodically rebalance, selling a bit of what's grown too large and adding to what's fallen behind, to keep their original risk level intact. Your ideal mix also depends on your risk tolerance and time horizon. Someone young, saving for retirement decades away, can typically afford more stock exposure. Someone nearing retirement usually shifts toward bonds and safer assets to protect what they've already built. There's also a flip side: over-diversification, sometimes called diworsification. Spreading your money across too many overlapping investments can dilute your returns without meaningfully reducing your risk. Diversification is about balance and intention, not simply owning as many things as possible. The 2008 financial crisis offered a powerful lesson. Investors concentrated in real estate and financial stocks were devastated. But those holding a genuinely diversified mix across asset classes and regions recovered significantly faster, because not every part of their portfolio was tied to the same collapsing system. At its core, diversification won't guarantee profits, and it won't protect you from every downturn. What it does is reduce the odds that one bad decision or one failing company can derail your entire financial future. It's one of the few strategies that gives you a real edge simply by being patient and spreading your risk wisely. So before you invest another dollar, ask yourself, are your eggs really spread across different baskets, or just sitting in ones that look different but break the same way? Start small if you need to, Mix asset classes, sectors, and regions, and let time do the rest. This video is for educational purposes only and does not constitute investment or financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions.